If you're feeling overwhelmed by today's headlines, stock market swings, inflation worries, government debt, you're not alone. Uncertainty seems to be everywhere. So today, we're going to break down the retirement investing ladder that could change everything for your retirement. We're going to talk about one of the smartest ways to create that reliability, building a personalized ETF bond ladder. So stay tuned because I'm going to show you exactly how to do it in this video. The biggest risk in retirement isn't just market volatility. It's being caught unprepared when it strikes. Your expenses like housing, groceries, travel, they don't just disappear when markets drop or inflation spikes. They'll keep coming, whether you're ready for it or not. Which is why I like this income ladder strategy. It can act as a bridge to get you to Social Security, a pension, or just ensure that your daily living needs are accounted for. Most people don't know how to pay themselves from their portfolio in retirement, and this is a great place to start. If you don't have a plan to lock in steady income now, you could find yourself selling investments at a loss, cutting back your lifestyle, or delaying the dreams you've worked your whole life for. Waiting until the storm hits is too late. The smart move is to prepare now, while you still have control. And building a bond ladder is one of the most powerful ways to secure the steady, predictable income your retirement needs, no matter what the market throws your way. And if you're new here, my name is Nathan. I'm a certified financial planner, and I've been helping people retire confidently for over a decade. If you find today's video helpful, please make sure to like and subscribe. Not only will you get more tips on retirement planning, but it also helps me grow this channel and reach more people just like you. While today's video is geared toward those who like a hands-on, do-it-yourself approach, I know many people want help figuring out how this fits into their bigger retirement plan, and that's why you'll find a link below where you can share a little bit about your retirement goals with me, and I'll send you back a personalized video on ways that you can retire with confidence. So let's get into this video and answer the question, what exactly is a bond ladder? Think of it like climbing an actual ladder. Each rung represents a moment in time. Maybe it's 6 months or each year. The key is you don't leap to the very top. You take it step by step, using each rung to stay balanced and move forward steadily. A bond ladder works the same way. Instead of putting all your money into one long-term bond, you spread it out over several bonds that mature at regular intervals. One in 1 year, another in 2 years, then 3, and so on. Each maturing bond becomes a step that helps you stay flexible and keep you moving towards your goals. Pretty soon, it starts to look and feel just like a ladder, steady, predictable, and designed to get you where you want to be. Each maturing bond is like stepping onto the next rung. You get paid along the way for owning the ladder, and you get your principal back when you need it to cover that year's retirement expenses. You can start with the basics, covering your necessary expenses like housing, food, and day-to-day living costs. Maybe that's $60,000 a year for you. You can build a ladder with bonds maturing over the next 4 to 5 years to cover those essential expenses. And what if you know you'll need extra money, like buying a new car in 2 years? You can add that amount into the second rung of your ladder, so it matures right when you need it, without having to risk that money in the stock market. So now that you understand what a bond ladder is, let's talk about how to build it with defined maturities. You can buy CDs, treasuries, corporate bonds, or municipal bonds. Each have their own risk and return profile, so it's important to choose them carefully. To give a high-level overview, CDs are going to be fully taxable, but have FDIC insurance guaranteeing them up to the limits. Treasuries are backed by the full faith of the government, and as a benefit, they are exempt from state and local income taxes. That could be a nice benefit in high-tax states, or if you're like me and live in New York City, where both state and local taxes are high. Corporate bonds are issued by companies, and depending on the strength of the company that issues them, they will have a rating that says how likely they are to pay the bondholders back. The riskier the company, the higher you need to be compensated for holding those bonds. Municipal bonds are issued by state and local governments. The benefit there is that many of these type of bonds can be exempt from both federal, state, and local taxes. So I share with you this because if you're a high income earner now, you might consider buying a municipal bond ladder in a taxable account and a corporate bond ladder in a retirement account. But a word of caution in that many muni bonds are issued with call dates that are prior to maturity. So you will have varying return potentials in your ladder that can be less predictable than corporate bonds. So now that we discussed the tax features, let me show you how to actually build this thing out. And in our example, we're going to use corporate bond ETFs. And there are plenty of places to do it, but we're going to use a publicly available website where you can also take a look for yourself. Invesco's website has a bond laddering tool that allows you to see how much income you will receive and what your yield to maturity is when you build out your portfolio. BlackRock also has a similar ETF option. I just happen to like the tools that Invesco gives me access to. So let's use corporate bonds as our example today to build out a bond ladder. In this case, we're focusing on investment grade bonds, which simply mean they're issued by companies that are considered financially strong and highly likely to repay their debts. And that's exactly what you want as a bondholder in retirement. Confidence that you'll receive your regular interest payments and that your full principal will be returned to you when the bond matures. So let's take a look at this bond ladder together. One of the great things about it is flexibility. You can allocate any amount that you want in any given year, depending upon your needs. So let's go back to our example needing $60,000 per year in retirement income. To build a bond ladder that aligns with that spending, you might start by purchasing $60,000 worth of bonds maturing in 2025. For example, using the ETF BSCP, which holds multiple bonds maturing that year. That covers your income needs for 2025. Then you'd continue by buying $60,000 in BSCQ, which matures in 2026. $60,000 in BSCR, which matures in 2027, $60,000 in BSCS, which matures in 2028, and $60,000 in BSCT, which matures in 2029. Now remember, in our example, you're also planning to buy a car in 2027. That means you'll want the money available in advance. So you could add another $50,000 to BSCQ, which matures at the end of 2026, giving you that cash right when you need it. When you lay this out visually, it starts to look like a true ladder. Each rung matching a specific year and a specific need, helping you stay organized, funded, and confident about the next steps. Now let's walk through what you're seeing and highlight the important pieces. First, a quick disclosure. The data you're looking at is as of April 25th. The numbers will likely be different by the time you view this, and there may also be a slight delay between when the data was captured and when it appears on the website. The distribution rate is a measure of the income an investor would receive if the most recent fund distribution continues at the same rate over the next 12 months. Next, let's take a look at the 30-day SEC yield. This is a standardized way to compare income of different bond funds. It gives you a snapshot of recent income performances across funds on a consistent basis. But just as important is the yield to maturity. So let's use the 2025 rung as an example. You'll notice that the yield to maturity is a bit higher. This matters more if you plan to hold the fund all the way through maturity. Yield to maturity tells you the annualized return you can expect if you hold the bonds until they mature, accounting for both interest payments and any gain or losses from buying the bond at a price different from its par value. And that's where the difference comes in. Bond prices fluctuate. For example, on April 25th, you would have been buying the 2025 fund at an average price of $99.74. But bonds mature at par, typically $100 in this case. So if you buy below par, that price will gradually move up towards 100 as it approaches maturity. And that gain is part of your total return. On the flip side, if you buy a bond at a premium above 100, you might actually lose a bit of principal when it matures at par. That's why it's important to understand both the income you're getting now and the price you're paying for that income. The longer the maturity date you choose, the more the bond price can fluctuate in the short term. But if you plan to hold the bond until maturity, that volatility really doesn't matter. What you care about is receiving your interest payments and getting your principal back at the end. Now, it is important to remember there are no guarantees with corporate bonds, but historically, investment-grade corporate bonds have had very low default rates. And in my opinion, that gives them a strong risk-reward profile, especially when you're looking for reliable income in a retirement plan. Another reason I like this ETF strategy is that it has a number of bonds in it so that you get diversification of different companies within that year. What's really great about this strategy is that you can lock in a solid income stream along the way. In our example, by spreading your investment evenly over the next 5 years, you'll earn a competitive yield each year and get your money back when you need it most. And here's something particularly helpful. These funds are designed to mature in December of the stated year. So if you need money available in early 2026, you can invest in the 2025 ETF, knowing that it will mature at the end of the year just in time when you'll need the cash. So why is now a good time to lock in yield? Have you looked at where interest rates are now compared to the past 20 years? If not, you might be surprised. I'm going to show you the 10-year treasury yield over the past 2 decades, and you'll see we're back at levels we haven't seen since the early 2000s. That means that most of the past 20 years, investors had to lock in a much lower income than what's available today. So from a historical standpoint, this is a relatively strong time to be a bondholder, especially if you're thinking about locking in income over the next several years. Now, I don't know where rates are headed from here. Yields are elevated right now because inflation remains a concern, and that's made the Fed more hesitant to cut interest rates in the short term. But here's the beauty of being a bond ladder holder. You don't need to predict the future. Whether the rates rise or fall, a ladder gives you flexibility. It lets you lock in solid income today, while it still gives you opportunities to reinvest as bonds mature or use the proceeds. There's no guesswork involved. So now that you've started building a bond ladder, what's the next move? In the example I've shown, we only use a 5-year ladder, which means that this is just one piece of your total portfolio, not the whole thing. The idea is that you use the ladder to cover your near-term income needs, while the rest of your portfolio continues to provide balanced growth over time. As each year passes and a rung matures, you'll have a decision to make. If the market is flat or rising, you can simply refill the ladder by adding another year out from your positions. But if there's market volatility, maybe stocks are down, you can wait to refill and give the market time to recover. The key is you are in control. You get to decide when to reinvest based on what's happening in the markets and what's best for your plan. I hope you learned something new today. And just remember, while bond ladders can be a powerful tool, there are still risks and variables to consider that we haven't had time to go over. If today's video gave you a clear understanding, I'm glad I could help. And if you'd like a bit more confidence in how this strategy could fit into your retirement portfolio, feel free to reach out using one of the links in the description. I'd be happy to walk through your retirement scenario with you and help you think through it. As always, thanks for watching and subscribing to my channel, and I'll see you in the next video.